Hi, this is Jim Lee of StratFI, and I'm here to share with you a few perspectives on the market. And rather than talk about very small changes in Federal Reserve policy or even more subtle changes in economic growth, I prefer to look at the markets directly as a daily indicator of investor confidence. And this is really what technical analysis is all about. And let's start here with a chart of the S&P 500, which you can see has really been moving sideways over the course of the last 18 months. The S&P 500 has been range bound with 2130 on the high side as resistance. And on the low side, we have support levels at 1870 and also 1820 as well. So current rally started in mid-February. We still have a little bit of room to go on the upside, which is kind of nice. The question here is whether or not the market will be able to sustain its momentum and enter into new territory by the end of the year. And I think that's quite possible. I don't know if that's going to happen right now just yet, and I'll share with you why. So in this next chart, we have a seasonality for the S&P 500, which talks about the monthly pattern that has been established for the market really over the course of the last 20 years. And what you'll see here is that most of the gains for stocks happens between January and mid-June, followed by this sideways movement throughout the summer, running from June really through beginning of October, followed by a year-end rally. And this is really the core of the market timing algorithm that I've been using with some success over the course of the last year or so. And based on this type of analysis, it suggests that we may have strength in the market running until about June the 17th, followed by a pullback in the second half of the month, followed by a little bit of waffling between now and September/October. But this is really just one way of looking at the market, and you really do need to take this, I think, with a little bit of salt as well. So something else that I'm looking at is something called the market map, which, there's a lot of data on this chart, but it is a really useful way of looking at 500 different stocks all at once. And it's actually quite intuitive to read. Green is good, red is bad. The big boxes represent big companies. The small boxes represent much smaller companies. And what you'll see here is even though the market's only slightly positive for this year, that there's a lot of green, okay? And what that means is that most stocks have been participating in the current rally. It has not been limited to a handful of issues. It's been a very broad gain for the market, and that's generally good news. Where some of my concerns are is the type of leadership that we're getting in the market. You look at the technology stocks, the big names such as Google and Facebook and Apple, they're all down 5 or 6% this year. You look at biotech, that's been a bit of a train wreck this year. Gilead down 15, Celgene down 10, Regeneron down 26. These are really the traditional growthy sectors of the market. And if the market was truly confident, you would expect better behavior from tech, biotech, healthcare, consumer cyclicals. What's leading the market right now are, generally speaking, more defensive sectors, such as utility stocks, which are up an average of 14% this year. You're seeing basic materials and energy stocks do well, up about 11% on average this year. You're also seeing very good performance for a second year coming out of consumer staples stocks such as Procter & Gamble and Altria and Clorox, right? These three groups, basic materials, which includes energy, consumer goods stocks, and utility stocks, are generally considered to be more defensive sectors. These are parts of the market that people go to when they're worried or when they want to have dividends and income. So I find that very interesting as well, because that's what's working right now. Now I'm getting a lot of emails and calls from clients talking about the presidential elections, and some of them are worried about Hillary and some of them are worried about Trump. And what I can share with you is really the pattern that we've seen for presidential elections going back since 1930. And this is data coming out of the Stock Traders Almanac, which really just has tons of useful little tidbits of information in it. And generally speaking, we go through this every 4 years, and most presidential election years tend to be reasonably good, okay, with returns sort of in the mid-single digits, as it were, and that's what this blue line is here. Now, when you have an election year after 8-year presidency, okay, and you've had really sort of a changing of the guard, you tend to have a little bit more uncertainty, as it were. And during 8th-year presidential elections, you tend to have much weaker performance from stocks, okay? Now, in this case, what the Traders Almanac has done is they've combined these three indicators, your sort of normal election year with your 8th-year election year with some early year indicators to suggest that markets will be flat to slightly negative this year. And, that's distinctly possible. I think I'm a little bit more optimistic about that as we go into the 4th quarter of this year, which is where I think we'll see most of our gains after a choppy summer. So that's kind of where I am right now, all subject to change, of course. So I'm going to change direction a little bit here and share with you something that I call the Rosetta Stone of market forecasting. And this is a framework to look at news and to look at the markets. And I've just found this to be tremendously useful stuff. You could almost pin it to your refrigerator for future reference, just because it shows how everything is connected. And here you can see how different types of assets are related and the sequence of those relationships within sort of this long-term deflationary environment that we've been in for at least the last 8 years. So a change of any of these boxes will create a chain reaction within the next box and then the box after that, eventually influencing stock prices. So pluses here indicate positive relationships. Minuses indicate inverse or negative relationships. So if you look at the US dollar, a stronger US dollar generally means more purchasing power, which often results in lower commodity prices, specifically lower energy prices. A weaker dollar tends to lead to more inflation, resulting in higher commodities prices. Now, commodities also have a relationship with bonds, specifically Treasury yields. And here I'm not necessarily talking about the short-term Treasury yields that the Federal Reserve sets. Rather, I'm looking at the yields of 10-year U.S. Treasury bonds to be specific. So higher inflation generally creates higher bond yields. Higher bond yields indicates really a confidence within the markets that would result in higher prices for stocks. And that's the relationship, and there's actually a fairly close linkage here between commodities prices and stocks. And sometimes those shifts are reflected almost instantaneously, although there's also a little bit of a lag, as you can see here. So if we look at these relationships and we sort of chart them together, in this particular graph, we're comparing the U.S. dollar, which is the black line, with the commodities index, which is in green. And again, the sequence is changes in the dollar happen before changes in commodities. So you could see that the dollar really hit some intermediate term lows towards the end of 2013 and had an amazing run throughout 2014, running through the beginning of 2015. Commodities really kind of peaked mid-2014. So there's this very strong, almost mirror relationship here. As commodities go down, the dollar goes up. As the dollar goes up, commodities go down. Now you can see right here that the dollar's beginning to break through its support level right here, and that the dollar has been losing strength relative to commodities. So in the next chart down, we have something called comparative relative strength, which is the value of the dollar divided by the value of the commodities index. A rising line indicates a strengthening dollar. A declining line indicates a weakening dollar relative to commodities. And that trend just started earlier this year. I'd say right around February if you want to be specific. Bottom chart I just think is really interesting. It's a correlation coefficient between commodities prices and the value of the dollar. Very strongly negative. An inverse relationship here. Actually, if you want to get really specific, you should pull up a correlation coefficient between gold and the US dollar, and you'll quickly reach the conclusion that gold is almost the anti-dollar. What has been holding the dollar up and actually pulling gold down a little bit is the fact that in the US we still do have positive interest rates on 10-year bonds, and that's somewhat compelling when you compare it to the negative interest rates that we have in Switzerland or Japan, or the zero interest rates coming out of Germany. So I think that's been part of the strength of the dollar that may be changing, who really knows. But what this would also suggest is that the bump in commodities prices may eventually translate into higher interest rates. That might not be a bad thing, but it just isn't happening yet. Okay, you look at yields of the 10-year Treasury; those have been in decline really since the end of 2013. Stock prices have been stable or sideways. There's a little bit of a divergence here. Okay. And what this says to me is the smart money isn't necessarily all going into stocks. Some of it may have been going into treasury bonds over the last year or two. I would feel better about the prospects for a continued rally in stocks if people started taking some of their money out of bonds. And the truth is, we just haven't seen that yet. It could happen. Okay. So in terms of getting the timing right, this is the time when I start looking at what's been working, what isn't working, and what should be working. Up to this point, we've had a lot of success in utility stocks, consumer staple stocks, again, the defensive, higher yielding segment of the market. We have a lot of utilities exposure within our sector rotation strategy, along with a lot of precious metals exposure. And the utilities look a little expensive at this point. A lot of them are trading at price to earnings multiple of 20 or more. And that's something that you would expect more in a growth stock than a low growth utilities company. Same thing for the consumer staples. You shouldn't see a lot of growth there, but they're priced like a growth stock. I'd say it's a little bit late to be getting into the game for those two categories. Now, what's early is this area of the emerging markets, which have just been relentlessly beat up for the last 3 or 4 years. Very cheap right now. Very dependent upon commodities prices, which seem to be rebounding. So I think that there are a lot of opportunities for stock picking in emerging markets. Strategically, we may want to start looking at shifting some assets into that area. Just have not done that yet. Another area worth spending some time on is energy and petroleum stocks. Had a rough year last year. They seem to be bottoming out and getting some good footing. So that's what I'm keeping my eye on right now. I found that a good portion of portfolio returns really is closely tied to being in the right places, having your eye on the right sectors of the market. So for the time being, it still looks like we're in a range-bound market, although short-term momentum is positive. In this type of environment, buy and hold has been a little less rewarding over the course of the last 18 to 24 months. Year to date, many individual stock portfolios are slightly positive, although some are slightly negative, depending upon their level of exposure to technology stocks, to be specific. Sector rotation has been a terrific strategy for StratFI this year, as has market timing. If you have a choppy sideways market, sometimes being able to move in and out of the market to gain those short-term bumps can be quite helpful. So if you have any questions on these strategies or the markets in general, feel free to give me a call or send me an email at jlee@stratfi.com. Thanks again for your time. Look forward to talking soon.